This is an emergency broadcast. Stop what you're doing right now. I need you to go to your bank app, check your savings account balance, and ask yourself when the last time was you earned actual interest that beat inflation. Not the fake 0.5% they're paying you while food costs double. Real interest. Because if you still think that number on your screen represents wealth, you're about to get a lesson in mathematics that will destroy everything you thought you knew about money. I need you to put down your phone. Stop watching Netflix because the entertainment is about to end. The financial system just entered cardiac arrest. We have officially entered a phase of systemic breakdown that will be studied for the next century. They won't call it a correction, they're going to call it the Great Treasury Collapse of 2026. Ladies and gentlemen, Asian Guy here, Alex Chen from Crisis Intelligence Network. It is Tuesday, January 28th, 2026, 3:47 p.m. Eastern, and the most important market in the world just suffered a massive heart attack. I'm talking about the United States Treasury market, the $28 trillion foundation that every other asset on planet Earth is built on top of. And I'm not being dramatic, I'm being mathematical. We are witnessing a dislocation in global bond markets that shouldn't be mathematically possible. In a functioning financial system, U.S. Treasury bonds are supposed to be safer than gravity. They're supposed to be the bedrock of planetary finance. But today, gravity just reversed. Physics stopped working. The laws of finance have been suspended, and we're all floating in economic zero gravity. I need you to focus on two numbers that define this crisis, because these aren't just statistics. They're autopsy results from the death of the global financial system. At 2:47 p.m. Eastern Time, the U.S. Treasury held its regularly scheduled 10-year bond auction. This is supposed to be routine. This happens every month like clockwork. The government needs to borrow money, so they sell bonds to banks, pension funds, and foreign governments. It's boring, predictable, and essential. But today's auction didn't just fail. It imploded like a controlled demolition. The bid-to-cover ratio collapsed to 1.73. That means for every $100 billion the Treasury wanted to borrow, there was only $173 billion in bids. In normal times, this ratio runs between 2.4 and 2.8. Think about what this means. It means that for the first time in modern history, global investors looked at U.S. government debt and said, no thanks. Foreign central banks, who usually buy 40–50% of every auction like loyal customers at their favorite restaurant, bought exactly 11.2%. 11.2%. That's not a reduction in appetite, that's a rejection. That's the equivalent of your best customers walking into your restaurant, looking at the menu, and walking out without ordering anything. The primary dealers, the big banks legally required to bid at these auctions, had to absorb 67.3% of the entire issuance. That means JP Morgan, Goldman Sachs, and Bank of America just got stuck holding $67.3 billion in bonds that nobody else wanted. They're not buying this debt because they think it's a good investment. They're buying it because they have to, and they're panicking about what to do with it. But here's where the mathematics become terrifying. While the auction was failing in slow motion, the secondary market was having a cardiac event. The 10-year Treasury yield spiked to 5.73%. That's a 40 basis point explosion in a single trading session. In bond market terms, that's like a magnitude 8.0 earthquake hitting during a gentle yoga class. My sources inside the primary dealer network are telling me that the real panic started at 3:17 p.m., exactly 30 minutes after the auction closed. That's when the algorithm started calculating what a 40 basis point yield spike means for the $28 trillion Treasury market. If you bought a 10-year Treasury bond yesterday at 5.33% yield and tried to sell it today at 5.73%, you just lost 4.2% of your principal overnight on the safest asset in the world. But here's where this gets interesting, and by interesting, I mean apocalyptic. While U.S. bond prices are crashing and yields are spiking like a cardiac monitor, something impossible is happening 7,000 miles away. In Tokyo, Japanese 10-year bonds are trading with negative yields. Negative. Investors are literally paying the Japanese government to hold their money. The spread between U.S. 10-year bonds at 5.73% and Japanese 10-year bonds at negative 0.15% is now 5.88%. 588 basis points. Do you understand what this spread means? It means the bond market is screaming that the US dollar is about to collapse while the yen is about to explode higher. This is a mathematical weapon that's going to trigger the largest capital flow reversal in financial history. Every dollar that was borrowed cheap in yen to buy US assets is about to reverse course and flow back to Japan like a tsunami running backwards. This is the carry trade unwind of the century, and it's happening right now while you're watching this video. Let me explain the mathematics of American insolvency because the numbers are so insane that your brain might reject them as impossible. The United States government is not just broke, it's mathematically broke. And today, the bond market finally did the calculation and realized the numbers don't add up. Ever. The federal debt has crossed $40 trillion. Not million, not billion, trillion. With a T. That's $122,000 for every man, woman, and child in America, including the babies born this morning who are already $122,000 in debt before they took their first breath. But debt by itself isn't the problem. Countries can carry debt if they can service the interest payments. The problem is the interest. At 5.73% on the 10-year, the U.S. government now pays over $2.3 trillion per year just in interest on existing debt. Not principal, just interest. That's more than the entire defense budget. It's more than Social Security. It's approaching 40% of all federal tax revenue. Let that sink in. Nearly half of everything the government collects in taxes goes just to paying interest on money they've already spent. Here's the math that broke the bond market's brain today. Federal tax revenue runs about $4.9 trillion per year. Interest payments are $2.3 trillion, and rising everyday yields stay elevated. That leaves $2.6 trillion for everything else. Defense, Social Security, Medicare, infrastructure, government operations. But mandatory spending on those programs is $3.8 trillion per year. The government is spending $1.2 trillion more than it takes in, even after paying the interest on the debt. So where does that $1.2 trillion come from? They borrow it. They issue more bonds, which increases the debt, which increases the interest payments, which requires more borrowing. It's a death spiral with only one mathematical endpoint: default or hyperinflation. There is no third option. The bond market figured this out at 2:47 p.m. today. That's why the auction failed so spectacularly. Foreign central banks looked at these numbers and said, "We're not funding this suicide mission anymore." The Saudis sold $47 billion in treasuries last week. The Chinese sold $23 billion. The Japanese, who have been the most loyal buyers of U.S. debt for 40 years, just reduced their holdings by $18 billion in January alone. But here's what should terrify you about today's yield spike to 5.73%. Every 100 basis point increase in Treasury yields adds $400 billion to annual government interest payments. Today's 40 basis point spike just added $160 billion per year to the deficit. The higher yields go, the faster the debt grows. The faster the debt grows, the higher yields have to go to attract buyers. It's a feedback loop with no exit. The Federal Reserve is trapped in a burning building with only two doors. If they cut interest rates to help the government finance its debt, the dollar collapses and inflation explodes. If they keep rates high to defend the dollar, the government debt spiral accelerates until it hits mathematical insolvency. Jerome Powell is standing between hyperinflation and default, and both doors are marked exit. But while Treasury investors are fleeing U.S. government debt, something far more dangerous is happening in the banking system. The carry trade unwind isn't just moving money from one asset to another. It's creating a liquidity vacuum that's suffocating every leveraged institution on the planet. This is where today's crisis moves from theoretical to personal. For the last 15 years, every major bank, hedge fund, pension fund, and insurance company has been playing the same game. They borrowed yen at effectively 0% interest, converted it to dollars, and bought higher-yielding U.S. assets. Treasuries at 3%, corporate bonds at 5%, real estate at 7%, stocks yielding 2% plus capital appreciation. The spread was pure profit with no apparent risk. The no apparent risk part just exploded like a landmine. When the yen strengthens against the dollar, as it's doing right now, those trades don't just lose money, they lose catastrophic amounts of money. A 10% move in the dollar-yen exchange rate can wipe out years of carry trade profits in a matter of hours. And we're not looking at a 10% move. We're potentially looking at a 30-40% dollar collapse against the yen over the next 6 months. Here's the math that's killing the banks right now. And I'm getting this data in real time from sources inside the major institutions. The yen just strengthened from 155 per dollar to 147 per dollar in the last 48 hours. That's a 5.4% currency move. But because these trades are leveraged 10 to 1 or even 15 to 1, a 5.4% currency move becomes a 54% loss on the leverage position, and we're just getting started. The Bank for International Settlements estimates there's $4.2 trillion in outstanding yen carry trades globally. About $1.8 trillion of that is held by U.S. institutions. When these positions unwind, not if when, those institutions have to buy yen and sell dollars to close their trades. That creates more demand for yen, which strengthens the yen further, which creates more losses, which forces more unwinding. It's a margin call death spiral that feeds on itself. I just received confirmation from a contact at a major investment bank that their risk management systems are flashing red across every dashboard. They're looking at potential losses that could wipe out an entire year of profits in the next 30 days. And they're not alone. Every institution that borrowed yen to fund U.S. investments is staring at the same mathematical nightmare. These institutions didn't just borrow yen to buy U.S. treasuries. They borrowed yen to buy everything: corporate bonds, mortgage-backed securities, leveraged loans, private equity, real estate, crypto, stocks. The carry trade funded the everything bubble, and when it unwinds, everything crashes at once. We're already seeing the early signs if you know where to look. Investment-grade corporate bond yields spiked 67 basis points yesterday. High-yield credit spreads blew out by 89 basis points. The mortgage market is freezing up as REIT yields explode higher. Commercial real estate is in free fall as financing costs hit levels that make most deals mathematically impossible. This is what a liquidity crisis looks like in real time. It's not that assets are fundamentally worthless. It's that nobody has cash to buy them because all the cash is trapped in yen carry trade liquidations. Forced sellers meet absent buyers. Prices gap down 20-30%, not because of fundamentals, but because of mathematical necessity. At 4:17 p.m. Eastern today, exactly 30 minutes after markets closed, the Federal Reserve announced an emergency liquidity facility for banks facing temporary funding pressures. That's central bank speak for some very large, very important banks called us in a complete panic and said they're about to go bust unless we do something right now. This facility allows banks to borrow directly from the Fed at below market rates using their underwater securities as collateral. Translation: the Fed just agreed to lend money to insolvent banks using worthless bonds as collateral. They're socializing the losses from the carry trade collapse and sticking taxpayers with the bill. But here's why this solution makes everything infinitely worse. By backstopping the bank's carry trade losses, the Fed is encouraging them to keep their positions open instead of unwinding them. This prevents the immediate banking collapse, but it guarantees an even larger explosion down the road. They're pouring gasoline on the fire to put it out. In forex markets, there are certain levels that matter more than others. These aren't arbitrary lines on a chart. They're mathematical boundaries where the physics of currency flows fundamentally changes. For the dollar-yen exchange rate, the most critical level in the world right now is 147 yen per dollar. And 23 minutes ago, we broke it. The dollar-yen exchange rate just touched 146.73. We are now officially in uncharted territory. The last time the dollar was this weak against the yen, it was 1998 during the Asian financial crisis, when Japan was actively defending its currency to prevent economic collapse. Today, it's the complete opposite. Today, Japan wants the yen stronger. The Bank of Japan historically intervenes around 147-150 by selling yen and buying dollars to keep their exports competitive, but not today. The BOJ is letting the yen strengthen because they want to kill the carry trade permanently. At 11:30 p.m. Tokyo time last night, the BOJ announced they're actively considering raising interest rates for the first time since 2007. If Japanese interest rates go from negative 0.1% to positive 0.5%, that's a 60 basis point shift that would trigger immediate liquidation of every yen carry trade on the planet. We're heading for 145, then 140, then potentially 130 over the next 3 months. Each milestone triggers another wave of forced liquidation. My sources at the Federal Reserve tell me that Chairman Powell is preparing to announce emergency measures that will dwarf anything we saw during 2008 or 2020. The Fed is preparing unlimited quantitative easing to backstop the carry trade unwind. Not $500 billion, not $1 trillion, unlimited. They'll print whatever it takes to prevent mass bank failures, even if it means destroying the dollar's purchasing power forever. The carry trade unwind requires approximately $4.2 trillion in dollar liquidity to close out existing positions without systemic collapse. The Fed's balance sheet is currently $8.9 trillion. They would have to nearly double their balance sheet to provide enough liquidity. Doubling the Fed's balance sheet means injecting $4+ trillion of newly created dollars into the system over months. That's more than World War II, 2008, and the pandemic response combined. Here's your emergency action plan. Execute this immediately, not next week, not when you get around to it. Every day you wait is a day that $4.2 trillion more capital flows out of dollar-denominated assets. First, get out of all long-term dollar-denominated bonds immediately. This includes treasury bonds, corporate bonds, municipal bonds, bond funds, and bond ETFs. If it's denominated in dollars and has a maturity longer than 1 year, it's going to get destroyed. Second, convert 20-30% of your cash savings to foreign currency. Yen, Swiss francs, or euros. Not cryptocurrency, not gold stocks, physical foreign currency that you can access if the domestic banking system freezes up. Third, buy real estate with fixed-rate dollar-denominated mortgages. When a currency collapses, fixed-rate debt becomes an asset. You borrow worthless future dollars to buy property that holds value in real terms. Fourth, exit all leveraged positions immediately. If you're using margin, if you own leveraged ETFs, close them today. The carry trade unwind is going to create volatility spikes that will trigger margin calls across every asset class. Fifth, buy physical gold and silver, not paper gold, not gold ETFs. Physical metal that you can hold in your hand. When treasury bonds become worthless and the dollar collapses, precious metals become the only store of value with no counterparty risk. This is not a prediction. This is not a possibility. This is mathematics. The debt cannot be serviced at these interest rates. The carry trades cannot survive yen strengthening. The banking system cannot survive without continuous Fed bailouts. And the Fed cannot provide those bailouts without destroying the currency. We are in the final phase of the greatest financial bubble in human history. And like all bubbles, this one ends with sudden, catastrophic collapse followed by years of economic reorganization around new rules and new currencies. Position accordingly. Act immediately. The goal isn't getting rich during the collapse. It's surviving it with your wealth intact while everyone else who trusted the system loses everything they thought they owned. But there's one more signal that proves the smart money already knows what's coming. While retail investors debate whether this is a buying opportunity, institutional money is executing the largest capital flight in modern history. State Street Global Advisors shows $347 million in Treasury ETF redemptions yesterday alone. That's institutional panic. Put option volume on Treasury ETFs hit a 15-year high. Someone is betting massive money that bond prices crater further. Gold broke above $4,800 per ounce while Treasury bonds collapse. Usually these move together during flight to safety events. When they diverge, it means investors don't trust any paper assets in the failing currency. Silver hit $147 per ounce as industrial buyers panic hoard for manufacturing needs. The corporate bond market is where real carnage happens. Investment-grade spreads blew out another 23 basis points this morning. High yield approaches distressed levels. Companies facing borrowing costs that threaten survival. My pension fund source tells me their board held emergency meetings last night. They're discussing moving 40% of assets out of dollar investments for the first time in 67 years. This isn't ideology. It's mathematical necessity to protect retirees from currency collapse. International shipping rates spike as exporters demand payment in stable currencies. Container ships sit in ports because importers can't agree on payment currency. Global trade is seizing up. The most dangerous development is the derivatives market. Interest rate swaps blow out as banks hedge treasury exposure. There isn't liquidity to absorb $4.2 trillion in unwinding carry trades. The derivative market becomes the transmission mechanism for systemic collapse. Credit default swaps on U.S. government debt, instruments that were supposed to be impossible, now actively trade. The market prices scenarios unthinkable 6 months ago. European banks quietly reduce U.S. exposure. Deutsche Bank unwound $89 billion in treasury positions last week. When European banks stop buying American debt, the game is over. When the dust settles, we'll look back at January 28, 2026 as the day the post-World War II financial system died. The transition to whatever comes next will be violent and wealth-destroying for anyone holding paper assets. This is Alex Chen. The Treasury market failed its stress test. The carry trade unwind executes in real time. The Fed chose hyperinflation over deflation. You have days, not weeks, to position for the post-dollar world. The mathematics don't lie, they don't negotiate, and they don't wait for anyone to catch up.